The next two quantitative instruments that we are going to talk about are reserves. So if you remember the video on money multiplier, I said that when the bank has a lot of capital, it is not able to lend out that entire capital to people or the general public because it has to maintain certain reserves as a buffer to maintain the financial health of the bank. For example, if a depositor comes and asks for the money, they should be able to repay that money to the depositor who needs it. That means they need to keep certain reserves so that the health and the financial survival of the bank can be maintained. And two major reserves, okay, that is what instruments, reserve instruments are cash reserve ratio and statutory liquidity ratio. Both of these are reserves. And then how do they differ? They differ on what basis, in what instrument do we maintain that money? Okay, let's say it is reserves. Do you keep the reserves in cash? Do you keep the reserves in gold, etc.? And where do you keep it? With whom do you keep it? Now, CRR or cash reserve ratio is kept with the RBI. Now, this cash reserve ratio belongs to the banks. So we are talking about the capital of the bank. Let's say the banks had a capital of 100 rupees to start with. And the reserve ratio is 20 rupees. And out of that 20, the Reserve Bank says that 15 rupees you have to keep as 5 rupees you have to keep as CRR and 15 rupees you have to keep as SLR. Now what does that mean? 20 rupee reserves have to be kept by the bank. Only 80 rupees can be lended out. That means 100 minus the reserve. Out of this 20, 5 rupees should be kept with the RBI. So the RBI has certain control over the bank. In case if they have some issue, the RBI can give this money to them and be like, pay off your depositors using this. Okay? And what you have to note here is that cash reserve ratio, like the name suggests, have to be maintained only in cash. Okay? Whereas the SLR of 15 rupees, now here this is 5 rupees, and of 15 rupees have to be maintained by the bank by itself. So if it's SBI has to maintain a statutory liquidity ratio of 15 rupees by itself in the bank itself, and it can save it as, or it can store it as cash, gold and government securities. So this is the way in which it differs. Both of them are reserves, but where the reserve is stored and in what form the reserve is stored changes. Now let us understand how increasing or decreasing the statutory liquidity ratio or cash reserve ratio will affect the money supply in our economy. Let's say you increase the cash reserve ratio. That means more money has to be set aside, and this applies to both SLR and CRR. More money, when the reserve increases, just put it simply, when the reserve increases, what happens? The bank has to put aside a lot more money and it can only lend some money. Let's look at an example. Initially, when it is 100, the deposit they have or the total capital that the bank has is 100 and the reserve is 20. It can lend 80 rupees. But let's say the reserve increases. The capital is 100, the reserve becomes 50. Now the bank can only lend 50. Doesn't this mean that credit creation is decreasing? Less credit is being created because the reserve is too high, and that leads to decrease in money supply. When credit is low, there's a decrease in money supply. And the same applies here. When reserve decreases, there's an increase in money supply. So if you go here, you have 100 and the reserve decreases to 10. Now they can give loans for 90 rupees. So this is how the RBI uses the reserve to control the money supply in the economy. Thank you.